This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performances do not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk. There's always the potential for loss. Your trading results may vary. No representations are being made that any software or trading will guarantee profits or not result in losses from trading.
Good afternoon, traders. I'm Scott Norris here with this week's Forex report. Today is Friday, February 9th, 2007. Well, Friday's finally here, and Forex traders cannot wait for Sunday afternoon when the G7 communique is released and the market is open again. This week's trading was much like it has been since the beginning of the year, with most majors searching for a direction. Even currencies that normally trend together are becoming more independent of one another, giving the dollar no clear direction in the broad market. This week's economic calendar in the U.S. was very bare, which left traders with only technical indications and foreign data to work with. Some of the week's biggest events included yesterday's interest rate decisions from both the BOE and ECB. While both central banks left rates unchanged as expected, the euro and pound sterling both found movement on these releases. The Bank of England's decision not to hike rates again was viewed as a disappointment and hurt the pound. Well, it was the ECB President Trichet's signal that rates would be raised in March that got the euro moving higher. The highlight of today's session was the Canadian employment report for January, which lent a hand to the struggling loonie. While the unemployment rate did unexpectedly tick up, the report indicated an addition of nearly 89,000 jobs for the month, 7 times more than forecast. This report, along with oil prices above $60 a barrel, has helped the CAD gain more than 100 pips on the USD today. As we head into this very important weekend, the technical picture is still very mixed for both individual currencies and the broad market. We can only hope that perhaps some of the G7 comments help these pairs find direction next week. Now on to the big picture. This week's big picture will focus on the G7 meeting taking place this weekend in Germany. One of the biggest questions yet to be answered is whether the weakness in the Japanese yen will be addressed. European officials are among those most concerned with the currency's plunge, as it makes exports from Germany and other E12 countries less competitive in the global marketplace. Japanese officials have indicated great disinterest in addressing this matter, however, and have received support from U.S. Treasury Secretary Hank Paulson. Paulson spoke on the topic earlier this week and assured market participants that he was not concerned with yen weakness and felt no need to discuss it at the G7 forum. Price action tells us traders have since sided with the U.S. and Japan, driving the yen sharply lower in the last 3 days. However, this does not ensure that currency will not be addressed in the communique. If we see some mention of unfair advantage, we will almost certainly see a mass exit on overdone carry trades. This includes the dollar-yen, as well as pairs that are much more overextended, such as the euro-yen and pound-yen cross pairs. Traders should evaluate any open positions, both short and long yen, before the market closes today, as there is a large amount of risk in holding such trades through Sunday. Till next week, hope you all have a great weekend.